Hey everyone, it's Ben Hardy here, and in today's video, I'm going to be talking about the recent Federal Reserve interest rate increase. We're going to talk about what this is going to do to auto loans, and then also what this is going to do to the broader car market based on the information that we have right now. Before we get into this video though, as always, if you want to save time and money, the next time you purchase a car, link to my car buying guide in the description down below. And then if you want to see more videos just like this, then I recommend you subscribe because I post content every single day. Let's get into it. So first off, if you haven't already seen, the Federal Reserve just increased the federal funds rate by another 25 basis points. And this will go into effect on February 2nd, which is the day that you will be watching this video, putting the federal funds rate at 4.65%. Now, the Federal Reserve didn't really give us a whole lot of information in terms of their game plan moving forward. They basically just said that, yes, we see that some things are cooling off, so we're going to do 25 basis points this time. And that's about it. They didn't say if the next meeting is going to lead to another rate increase or if it's going to be a rate decrease. Like, we don't know at this point. However, analysts within the markets are saying that there is a potential that this is it, but the thing that's more likely is that we will see a couple more rate hikes, or at least one more rate hike, until we get into the 5% range for the federal funds rate. Now, how long will that rate last for? Again, we just don't know at this point. Now, when it comes to auto loan rates, this will, of course, increase the rates of interest that you will pay on them. But, you know, what you have to understand is 25 basis points, it's not nothing, but it's also not a ton, and so it's not like rates are going to skyrocket, but yeah, they will increase slightly. And we're already at a point where rates are high enough that, you know, it's pushing a lot of people out of the market, and we'll kind of talk about that more in a little bit. But if we just look at the raw numbers, I mean, if you've got like perfect credit and you go and buy a brand new car today, then chances are you're going to get it quoted an interest rate in the 6 to 7% range, again, depending on term, depending on how much money you put down, all that. But then if you're like the average consumer where, you know, you have a credit score of under 700, right, high 600s, then you're going to be looking at an interest rate in the 8 to 9% range on a brand new car. And then if you're looking at a used car, well, things are even worse, because with used cars, interest rates tend to be a little bit higher because, well, used cars are a higher risk for a lender because, you know, you don't always have a warranty on used vehicles. And so with used cars, if you've got, you know, great credit, it's like you're getting close to that 10% range in terms of the interest rate you'd pay. And then if you don't have perfect credit, which again, that's what the average consumer has, is not perfect credit, then you're looking at well over 10%. And it's just crazy for me to see, because again, when I worked in the car business, like the only time I saw someone get an interest rate of over 10% is if their credit was like pretty shot, like they were in a bad situation. Whereas now it's like you can be really good at paying your bills and making sure that like your finances are in line, and you're still going to have to pay that much interest on an auto loan. Now, before we talk about what this is going to do to the car market, I want to go over some stats to set the stage for this whole situation. So, as stated by KBB, the average brand new luxury car is about $67,000. The average brand new non-luxury car, about $45,000. And then the average car transaction, brand new, happens at just under $50,000. Now, if we dive into used cars, well, the average used car is now just under $30,000, which is good news because it's going down, but they're still pretty dang expensive. Now, this is info from Bankrate.com. They state that the average brand new car payment is about $700 per month, whereas the average used car payment is over $500 per month. Now, this comes from World Population Reviews in terms of figuring out the average U.S. income by individual. It's $63,000 as of 2023, whereas if we take the median, which is probably more accurate as to what people actually make on an individual basis, you're looking at $44,000 per year. So again, jump back to those numbers. The average luxury car, $67,000. So that is even more than what the average is, and it's way more than what the median is for income. And then you look at the average just brand new non-luxury car, well, it's pretty much identical to what the average, or not the average, the median person makes here in the US, which is probably more closely correlated with what the average actual person makes here in the US. And so you can see that affordability with cars is not exactly there for the average person anymore. One more stat that I almost left out, and that is in regards to that median income. So if you take that median income individual and you give them a brand new car loan, which is, usually around $700 a month, that's about 20% of their monthly income. And that's obviously that's their pre-tax income, right? So you take their post-tax income, it's even more. And then if you compare that or take that value against the average used car payment, you're looking at about 15% of their pre-tax income. That's a lot of money per month to be spending on a car. So again, the average brand new car, non-luxury, is equal to the average person's yearly salary. And if they take out a loan on that brand new car, they're going to be paying over 20% of their pre-tax, almost 20% of their pre-tax income and over 20% of their post-tax income on a car payment. Let's start off by talking about the used car market. So if we just take a snapshot of the entire used car market, then what we will most likely see is the same boring trend that I just talked about over the sales month of January, where used car values pretty much just flatlined. Like they went up a little bit, they went down a little bit, and by the end of the month, it's like they're pretty much in the same exact place. And so that trend will most likely continue with this rate increase because you have a lot of people basically getting kicked out of the new car market and being pushed into the used car market, which is putting some upward pressure on prices. But what you also need to understand is that within certain price brackets in the used car market, this trend might not be a trend. So like cars that are under $10,000 are still extremely hot in today's market because like people just see that as super affordable because, well, it is super affordable, right? And so with those cars, you're not really going to see any price declines anytime soon. But if you're looking at some of the more expensive Highline cars, so what I'd consider a Highline used car is probably anything that's over like $60,000, we're probably going to see bigger and bigger price declines with these vehicles because there's just less and less people excited about paying that much money for a used car unless it's something that is really special. And even for the really special stuff, I'm starting to see quite a bit of demand destruction. And so again, just depending on the price range that you're looking at within will determine if you're going to see some, relatively big discounts in the near future, or if you're not really going to see any discounts. But again, if we look at the broad snapshot, the used car market's just pretty much going to be flat, which I know is boring, but it's the reality we're in right now. Now, when it comes to the new car market, just like the used car market, it depends on the price range that you're looking at to determine what is going to happen over the coming months. So with new cars that are under $30,000, they're still going to be really hot. And frankly, they're going to get even hotter as these interest rates continue to increase. If the Federal Reserve, does some more rate hikes because, well, I mean, just do the math, right? If the interest rates go up, then that means that the price range that people are shopping in when it comes to a new car is going to naturally go down. So don't expect new cars under $30,000 to get any cheaper anytime soon or to see any rebates or any sort of discounts. Now, I do see a lot of downward pressure on the over MSRP asking prices on these cars. And so vehicles like the Ford Maverick, for example, Honda Civic, Toyota Corolla, a lot of those are starting to see those over MSRP asking prices diminish. And so I think that is probably the best case scenario with these new cars under $30,000 is that you'll be able to get one at MSRP, but the chances of getting one at under MSRP with a lot of cars in this price segment, it's pretty unlikely at this point. Now, the $40,000 to $100,000 price range is seeing a lot of demand destruction. This is a trend that I've talked about over quite some time, and it's just going to continue because in this price range, you have a lot of non-luxury cars that just everyday average people purchase, and they can no longer purchase them because the purchase price is too expensive, especially in conjunction with the interest rates that we currently have. And so vehicles in this price range are just stacking up on dealer lots unless it is a hot new product. A good example would be like the new Kia Telluride and Hyundai Palisade. Those are pretty much just selling out right away, but give those cars a model year or two with the current economy that we're in, and you'll see them stack up on dealer lots. This price category, it's just too crazy right now for today's market. And so this is where I'm starting to see more and more dealers just release heavy discounts on these vehicles just to sell them. And manufacturers are kind of slow to jump on the rebate train at this point, but I foresee that happening in the very near future. Like with pickup trucks, for example, back in the day, it was, pretty commonplace to see $10,000 off of MSRP. And I think that we are veering towards a market where that's going to become commonplace again. However, I don't know if that's going to be enough to be able to get rid, like with pickup trucks, for example. I don't know if that's going to be enough to get rid of them, because like pickup truck prices have increased by so much that it might be a $50,000 to $20,000 off MSRP. Maybe the numbers I'm throwing out are crazy, but like at the same time, it's like, I don't think so, because when I review these brand new pickup trucks and I see like, oh, what's the MSRP in this truck? $65,000, and it's the middle of the line pickup truck. It's like, how is that affordable for the average Joe? It's like, this thing needs to be like 40 something thousand dollars, not 60 something thousand dollars. And so, yeah, regardless, with this segment of cars, we're going to see more and more demand destruction unless heavy discounts are rolled out by the manufacturers, because like I stated earlier, it seems like dealers are kind of ahead of the curve, where they've already discounted a lot of vehicles within this price segment quite a bit. There are some dealers that are obviously holding fast and they're not releasing discounts, but eventually something's going to have to give, because they're going to have to want to start selling cars, right? They're going to get too much inventory, and they're going to want to just get rid of stuff and get their new allocation. So yeah, just give this segment some time. Now the next category is going to be Highlines, and then, you know, luxury cars as well. So most of these cars are going to be, you know, $80,000 plus, and it's just going to depend. So like the really like bougie expensive stuff, so think like your high-end Range Rovers and Lamborghinis and all that, that stuff is actually still really hot, because, well, the demographic that goes after those types of cars is not really struggling right now. Like, they're still making plenty of money. But the more affordable Highlines or luxury cars, those are starting to see quite a bit of demand destruction, because the demographic that typically goes after them is currently getting laid off by their tech companies. All jokes aside, like, we're seeing major layoffs with, you know, high income W-2 individuals, and this is obviously putting quite a bit of downward pressure on that portion of the market. So I guess if you're in the market for like the super expensive bougie stuff, you're probably still gonna have to pay some sort of price premium. But if you're in the market for a bougie, less expensive thing, whatever you want to call it, then, you know, I wouldn't say that they're necessarily going to be like huge rebates, but we could potentially see some deals form in the near future, especially on the used market, where we're going to see more normal depreciation with these vehicles, where you can, you know, pick up a used luxury car for a third of the price when it's only a few years old. So to pull everything together, this recent rate increase is obviously going to have an impact on the car market, but the impact isn't going to be equal. And the biggest negative impact is going to be to cars that are, again, in that $40,000 to $100,000 price range, especially like at the $40,000 to $60,000 price range, I would say, because with these cars, again, they're typically purchased by, you know, the average individual, and the average individual just cannot afford cars in that price range right now. And so, you know, your guess is as good as mine in terms of when we're going to see discounts, or if we're going to see discounts, but I think that the writing's on the wall at this point, and so it's really just only a matter of time until, you know, dealerships and manufacturers are going to have to roll out more discounts on product within this price category to just convince people to buy, because everything's just a little bit too unaffordable at this point. But anyways, I'll see you.